In this video, we're going to talk about GAAP. So GAAP stands for Generally Accepted Accounting Principles. And basically what GAAP is GAAP is a common set of rules and principles and standards that companies have to follow when they're putting together their financial statements for external users. And when I say external users, it could be the government as one of the external users. It could be a potential investor, a current investor, a creditor like a bank or something like that. And so this company, they're putting together these financial statements. And so this is actually pertains to financial accounting. When someone's talking about GAAP, they're not talking about management accounting. They're not talking about tax. They're talking about financial accounting. So like putting together income statement, balance sheet, and so forth. They're putting out these public disclosures, these financial statements, and they need to follow a common set of rules so that when an investor is looking at two different companies and they're trying to compare them and make an investment decision, they can know that, okay, these financial statements were put together based on the same set of rules. It's not like one company's following one set of rules that they made up on their own and another company's following a completely different set of rules. That would make it really hard for investors to allocate capital and decide how to invest. So let me give you an example here. So let's say that we've got two companies. They're both appliance stores. So they sell like laundry, like for example, a dryer, a washer, let's say a dishwasher for washing dishes. So we've got Santa Claus appliance store, and then we've got the Naughty Elf appliance store. Okay, so each of these appliance store, they sell a dishwasher on credit. So that means the person doesn't pay cash. The customer doesn't pay cash. They just say, I promise to pay later. So they buy a dishwasher on credit for $700. Each of these stores has the exact same transaction, right? So this Santa Claus does this, and then Naughty Elf does this. And let's just assume everything else is the same, right? Let's assume that it's just the same level of risk with each customer, the whole 9 yards, right? This is a basic sale on credit. So what we would expect that both these companies would recognize a sale of $700, right? Once they've shipped out the dishwasher or delivered it to the customer and so forth, right? And we'll talk about that in future videos about when you'd actually recognize a sale. But let's leave all that aside. Basic ideas, there's a sale on credit of something for $700. Each of these companies should be recognizing that, hey, we have this sale. And so we don't want to have a situation where, for example, let's say Santa Claus said, well, actually, we haven't received any cash yet, so we decided we don't want to recognize a sale. We'll wait till we actually receive the cash. That's actually called cash basis accounting, and you can't do that because we have to follow what's called accrual accounting. And we'll talk about that more later. But the idea is that we have to have a common set of rules here where we say, okay, look, each of these stores, if one is recognizing the sale, then the other one has to be recognizing the sale if they're following the same framework of accounting rules. Now, it can get a little tricky because we might get into things about like, okay, well, what are the chances that this person who bought on credit will actually pay? Do we need to set up an account to acknowledge that some of these credit sales won't be collected? And then there's different methods that you can use. You could use the aging of accounts receivable. You could use percentage of sales. Don't worry about all that. We'll talk about that in the videos to come. But the main idea is that even though we have this common set of rules, where some of the basic things, it's like, okay, the companies have to follow these same rules, there's some flexibility in there in terms of which methods that the stores can use. However, that being said, all those methods, everything has to be GAAP, right? They can't just make up their own stuff. It has to follow this common set of rules. Now, that being said, what is GAAP depends on where you are, right? So your country is going to decide, do they want to make up their own GAAP, which we refer to as local GAAP? So the United States, for example, they have their own GAAP, right? So they have this board called the Financial Accounting Standards Board, the FASB, and they basically have this accounting standards codification. So the FASB, they make the accounting rules, right? There's this private agency, they make the accounting rules in the U.S., and that is the GAAP for the U.S., right? So the generally accepted accounting principles in the U.S. are made by the FASB. However, there's also international financial reporting standards, right? So you can think about that as international GAAP, and over 100 countries have adopted IFRS.